Hey, good morning, everyone. Welcome to the Truth About Real Estate podcast. Today, we're here with Susie Lee and Sara Jung, our guest. Sara Jung is in Legacy Bloom Investment. She is the founder of that, and it is talking about real estate syndication today and senior investing, senior housing. Welcome, Sara, to the show.
Thank you, Matthew, for having me. I'm so excited to be here.
Welcome. Yeah, we're excited to have you here. I've been meaning to, start talking to more investors and syndicators and showing our audience and our clients and guests about real estate syndication. It's a great platform to be in and to learn about. It's, for me, what I see as the next step to real estate investing. First off, can you tell us more about you?
Yeah, sure. Yeah. Again, well, thanks for having me. This is actually my first time being on a live show. So
we're the first. You're here now.
Yeah. So I have been, so my background is actually, I've been in mortgage banking and real estate for the last, actually almost 19 years now. I actually got into lending almost right out of college. I actually moved to Silicon Valley from the Midwest to be in technology. And then within a year, when I moved out here, I got recruited to go into a bank. And so that's where my career started in lending and in mortgage banking. And I just, I've been there ever since. And so that's where I started. And then we got into real estate, along with that, just kind of the natural, course of things when you're in finance and lending, you're working in real estate. So then we had bought real estate. And we started investing, and so that's how I started to get into the whole syndication business as well.
What made you want to get into real estate investing? Why real estate investing? Why not stocks or other options?
Well, when you're in the mortgage business, you're kind of living and breathing in the real estate business anyway. And so, what happened is that, I've seen so many clients over the years, buy and sell real estate. So early in my career, we had a lot of clients that, they bought rental properties. There was several years where I did construction lending. And so you just see a lot of different people buy, real estate for different reasons. And then over time, you start to see what the, kind of how those deals start to play out, over the years. I've had a lot of clients over the years that I've kept in contact with. I've done their loans, over and over, and we've had, long relationships over the years. And so I've been able to see, how, from where they started to where they ended up. When the real estate crash in 2008-9, that was a really interesting time that, affected me, affected a lot of my clients. But still, even through that, I still saw just the huge benefit of real estate and the benefit of real estate investing and what it can actually do for somebody over time. So even through all of that chaos, once you came out of that, if they were willing to stick it through, they still made out better, even after. And so that's what started me, as I, developed, as I kind of went through my career, was, basically just, real estate was really where it is. And so, I wasn't really big into stocks. I really didn't have the gut for just kind of dealing with the volatility of it. I just didn't understand it enough. It was just too speculative. And so it wasn't something that I understood well, but I understood real estate well. And I was able to see the benefits of it personally, and also for myself too. And so that's why we started investing in real estate. And so we were able to directly see those benefits over time, as well as, helping out my clients.
I think that's a great point. Real estate investing is a big part of what we do too. We love real estate investing and how it has a big factor in, creating passive wealth and creating a lot of equity and having a home. People need homes in life, in the world. They need homes. So you're for me, I say it's kind of like a kind of guarantee where you can't predict the exact property and the acquisition and equity and what happens. But if you can kind of understand that, people need to rent, people need to live, people want to be in certain locations. And if you can find the right locations, the right properties, maintain it. It's something physical. I like to have a physical asset more than a stock. I can actually touch the house, see the house, know what's going on, the condition, and say, hey, I think this area is going to go up. So I think that if we buy this investment here and we see the market changing, even in '08, even now, that there's opportunity to be there. And if you can look around, you can quickly see what's going on. And if you know the local market or have boots on the ground, you understand
Yes.
more. But for a stock perspective, you don't have any control. You're looking speculative of news, what's going on. You don't have insider news. You just have what you see on the market, and that's hard to predict. You have to have like real experts who know the industry inside and out, and it's hard for everyone to know exactly all the places you want to be buying into. Like when you saw, for example, Tesla, they're at 850 and they dropped to 350. I'm sure everyone's gut hurt really bad. How do you handle that kind of big drop, right?
Right, right. Well, and I totally agree with you, Matthew. I mean, we're on the same page on that. I mean, one of the things that, I mean, again, with stocks, I mean, you have to invest in the asset that you're comfortable with and that you're familiar with. And that's what I tell everybody. If you're not familiar with it, don't invest in it. If you're not comfortable with it, don't invest in it. You have to like real estate. You have to be comfortable with real estate. It has to be kind of an asset class that you like and that resonates with you. Stocks resonates with certain people. It doesn't resonate with me. It just wasn't a fit. It's like if I want to go out and become a professional investor, stock investor, I mean, I'd have to, spend a lot of time and energy. But the thing is, it's not even worth it because, again, you're not an insider. You don't really know what's going on. You can try to read the news and, everything that's maybe going on with those companies. But to me, I mean, stocks, stocks, it's an emotional roller coaster, right? And so because it's speculative, because people are acting on their emotions, and that's why you have so much volatility, because as humans, that's how the stock market is. It's based on emotions. It's not based on necessarily fact or reality. It's based on the perception of what people think may be happening or speculating what could be happening. But you don't really know exactly unless you're in the inside. And then even if you're in the inside, you still don't really know. You can't predict those outcomes exactly. And so with the real estate, at least there's data behind it. And it's, again, like you said, it is a physical asset. So, you are not speculating whether, you're not guessing, you're not really guessing as much, right? Because you have, there's facts around it. There's material, there's, it's brick and mortar. It's a place for people to live, people to hang their hat on. It's, so it's a lot more stable and safe, in my opinion. And I have seen that over and over through the years. I've seen clients lose a lot of money, lots and lots of money in their stock. I mean, especially back in 08, 09, 010. I mean, I remember, you were back in the business. It was crazy. I mean, we had customers they lost massive amounts in their portfolio. I actually had clients that literally had to start over and they were almost at the point of retirement. They were planning on retiring the next 5 years. And so, it was very tragic. And so, so some of those people, they did have to start over. And so, a lot of us had to start over, including myself. So, but it was tragic to see that happen. And, even in this last go around, even with COVID, I'm in a few syndicated deals myself. And we had done a deal last year where we had brought in, I had some investors in, and I can't tell you how thankful they were when the stock market plummeted, a couple months ago. And they actually were like, I'm so thankful that I was in that real estate deal because I didn't lose any money. Like you don't lose any capital in that, because it's not like you're selling the property today. So it's just a different animal.
Yeah, exactly. I think, for example, you heard of, I know you know Michael Blanc and his syndication.
Yes, I met him last year. Yeah,
and that's how I met you too. I met you on Michael Blanc's.
Yes, that's how. Yes.
Yeah, that's how we met. We're talking about that, and I think one of the things he did really well was, he's doing a lot of podcasts, he's doing a lot of education, he's providing a lot of value in terms of real estate syndication. Another great thing he put in was that a market report which talked about real estate syndications versus stocks. And that's a great report because it talks about all the different benefits and how they analyze syndications, real estate investing, every benefit you can get from that versus stocks. And when you look at it and think about it, the long-term picture, it makes so much more sense. And that way people understand it actually does. And proof of concept that that's a great way to go. And people actually learn from that, go, oh, I actually didn't realize all these benefits of real estate syndication,
No, absolutely. And, the beauty of the syndication, so I discovered syndication a few years ago. And I really wish I would have learned about it sooner. So over the years, I bought and sold real estate properties, and, it's always been the struggle of, just, coming up with a down payment or just, kind of the balancing act of, when you want to buy a property, going through all the numbers, figuring out how much down payment you need, how it's going to make sense, doing your cash flow analysis, all of that. But if I would have known about syndication, I wish I knew about it, 10, 15 years ago. Because at that, I didn't realize, that you could leverage other people's money. I knew about the concept of about it being leveraged, but I didn't realize that you could actually leverage it in a real estate deal legally. And so when I discovered that, I was like, well, that just makes perfect sense, because if you're trying to, get into a bigger deal, if you're trying to buy an apartment building or any of that, it's like, you can't, you don't necessarily do that by yourself. And I used to wonder how do people buy those apartment buildings? And I remember thinking back several years ago, I'm like, it'd be really cool to buy an apartment building, but I don't know how I would do that. And I just never really pursued it. And because I just didn't know enough about it. And so then when I came across syndication a few years ago, I was like, this just makes perfect sense. You're leveraging, you're sharing the risk, you're distributing, not only the risk, but, you're sharing the profits and the cash flow. And so, you're not in it just alone by yourself, taking all the risk on by yourself. And so that's what I really liked about it. And then, the fact that as an investor myself, I'm able to get the cash flow and the equity and all of that from those deals. And even though it's a small percentage, of the total deal, we're talking about multi-million-dollar deals. Even though my piece is just a small, part, but still, if I get, 17, 18 returns, that's stellar. You're not going to get that in the stock market. And you're investing, I'm investing in something that the people can live in, that they get a benefit from, that you're providing value to the community, especially in some of these apartment deals where we're doing value adds. We're improving, we're improving the building. We're giving them, we're giving people a better place to live. We're bringing value to them. And so that was another aspect that I really liked about it.
Yeah. Sarah, actually, so you mentioned that you saw a lot of benefit through the chaos in the 08-09 crisis. So, and you're involved in some syndications yourself right now. Do you see any benefit with investing right now? And what kind of, advantages do you see with the market right now?
Well, I think it depends on what type of investment we're talking about. I am a huge proponent of buying real estate right now. Interest rates being under 3%. You're not going to get this money. You're not going to get money that cheap again. I believe not for a long time, maybe ever in our lifetime. But then again, I thought that back in 2010. So again, you never know. So rates are like in the high twos right now. They're just crazy. So absolutely. I am a huge proponent of buying real estate, whether it be, and especially if you're going to buy real estate to live in, if you're going to buy a primary home, if you've been wanting to buy and you're on the fence and you're not sure, absolutely. Because what you're going to do is you're locking in that value for 30 years. You're buying the cheapest money that's available. Even if worst case, let's say that you buy a house and it goes down in value and you're afraid it's going to go down in value in the next couple of years. And that may happen. But if you're going to buy a house to live in, then to me, and I've told my clients this too, unless you're going to sell, unless you're planning on selling in the next 1 or 2 years, it doesn't really matter, because if you're going to be there for the next 5 to 10 years, if you're going to, hold on to this property for a while, you're going to be able to withstand some of those dips that may happen, because you have such a low interest rate, because your money is so cheap. You're borrowing such cheap money. If the interest rates were at 5%, I would say, that's a little bit different. Then I would maybe rethink that, and you might have to kind of look at those numbers more closely. But anyone that's wanting to buy real estate, or if they're wondering if it's a good idea or not, I say, jump in, buy it. Get the cheap interest rates. I'm all for that. So that's kind of my answer on that. When it comes to multifamily, I believe that there's going to be some interesting, I think there's always deals to be out there for multifamily. But I think, with the COVID environment, I think that there's also, we have to kind of really look closely at some of the occupancy numbers, the collection numbers, and just see kind of what happens in the next like 12 to 18 months on that end. It's not to say that I don't think there's definitely deals out there, but we are looking at deals much more closely, and we're underwriting basically COVID style now. So I think that there's deals out there. Again, money is still cheap. And so that's probably the biggest motivating factor in my opinion.
Nice. So, for example, I actually started in real estate in '08, and actually started when I was 24. Bought my first San Francisco house when I was 25. And what we did was, became an agent right after that, and actually started specializing in multi-unit investing and helped a lot of clients buy multi-unit buildings. During '08, even though it was a really bad time to start real estate, it was actually a good time for me. And luckily, I found clients who can actually put purchases on. So we're putting so many offers on. We're winning great properties. We're winning properties that it's kind of unheard of to find these great deals, and just putting it in place to people who can put their foot in the door and be stable and know for the long haul. So what happened in '08 and even today is, underwriting conservatively to understand what you're buying, what the risk factors are. And if you're stable and can afford it, then go for it. But those people who bought and could do it turned out really, really well for them. And the other people who could afford it but were hesitant, they lost out big. Some people didn't want to pay $30K, but in 4 months, 6 months later, the house went up $400,000. And they could afford it, but they just didn't feel comfortable. So investors have different scales of risk factors, and we understand that. One thing I kind of try to remind, and I heard from Brandon Turner before on bigger podcasts, is if the deal doesn't work for you today, why don't you try to rewrite the numbers to make it work for you? If it's a good property, good deal, and it's just not working, figure out what would make it work. Better terms, better pricing, waiting longer for the person to change their mind, especially during COVID times. And of course, depending on the area, and if you're buying multi-units versus single family, sometimes you can say, hey, if we can raise the rents, for example, or if we can lower the price, change down payments, change the structure of the financing, there's so many adjustment variables. But as long as you're writing conservatively for what you need, then it could become a great deal, right? And sometimes multiple properties to do it.
Absolutely. And having the lending experience, lenders now, both residential and multifamily, I mean, you have to build in those additional reserves. They're just, the whole underwriting process is a lot more conservative. And so, making sure that you're well capitalized is a huge deal, because, we're seeing deals now that are coming back on the market that were bought, in the last couple of years, and they were not capitalized well enough. And so they're actually starting to come back and being resold. And so, so just things like that. So just, making sure that you're well capitalized, you have plenty of reserves, more reserves than you would normally underwrite to, having being more conservative on your occupancy numbers. I think with COVID, it's not necessarily occupancy is definitely, a concern, but also just the collection amounts, the bad debt, that's also, just being, more conservative on those numbers, and then building in, those potential risks that those numbers would worsen potentially in the short term. And so, yeah, you're absolutely right. I think managing that risk is really important, and, taking all of those factors into account. And not, the way that, we would underwrite and analyze deals before is not necessarily how we're going to analyze them today, post COVID or during or post COVID. And, when we, and just in general, whether COVID or not, underwriting a deal and analyzing a deal, you have to make sure that you're building in your risk factors to make sure that deal is going to work for you. And then going back to the seller and saying, okay, this is how my numbers work. This is how I've underwrote it. And, over and over again, I'm sure you've experienced that sellers have their prices. They're kind of in dreamland, honestly, on some of their prices.
Sometimes,
but
yeah.
you have to underwrite it, and you have to analyze it based on what is going to work for you, based on your what you're wanting for your cash flow and what's going to make sense. I think, for a while there's, I think when you're a newer investor, it's really easy to get caught up and, you just want the deal, because you're so hungry to get into it and get that deal. And, and it is disappointing when it doesn't work out, but it's always, I'd rather be disappointed now than, much more disappointed later. So, so yeah, absolutely. I think he's got some really great points. And actually, I've looked at his content. He's got tremendous value. He's got all those nice calculators and everything on there. that I've used. And yeah, just analyzing it to what's going to work for you today, versus thinking what's going to work tomorrow. And so that's how you have to go. And you have to go into the deal today with based on what it is today, not what you think it's going to be.
Yeah, especially now too, being the fact that we already passed 120 days, you actually have a good historic data now of properties. If you're going in as a syndicator now or an investor now to a syndication, you can kind of ask questions like, hey, how has the last 4 months been for these buildings you're trying to buy? Has, with COVID going on, how has the vacancy been? Some buildings actually, like in our syndications, we see with clients we're passively investing in, some of the syndications actually have really good rentals, really good low vacancies, and clients actually paying. Some buildings have a bigger part where either they're vacant or there are tenants not paying, but they already factored that in. So luckily when they bought their properties pre-COVID, but they had already reserves in mind to adjust for any economic downturns and a good amount of adjustments. I've seen some vacancy factors up to 25%. And they're getting good deals on it. So we knew when we're buying it, and we're hoping, of course, we don't know for 5 years from now, but seeing what's going on with them, really need good operators who understand the market, who have probably been here in '08, who's been here now and can say, hey, they're different kinds of like pandemic versus economic downturns. But if you can analyze your numbers and know what's good for you and your investors, then you can make smart decisions as best as you can control. It can turn out really well. And I think syndication is a great way to go into passive investing in real estate.
Absolutely. I think, because I'm so like you, I invest both passively and actively. And it's such a great, even though I actively invest in real estate and I have an active, business in real estate and lending and all of that. But I'm also a busy person, and I don't, even though I'm working on my own real estate business, I'm also in my own passive investment deals too, because, there's some good deals out there, and, and there's a place that, that you need to put funds. And so I went the direction of doing, self-directed 401k and all of that. And it's actually worked out pretty well for me so far. But being passive, I think is such a good, it's been such a good strategy. And that was kind of, when I started investing in real estate, that was kind of the whole point was, how do I get my income to X, right? So everybody, and it's all out there. Everybody wants, to basically have income and not work for it. I mean, and not to say that real estate investing is, you're not working for it, but as a passive investor, it's great because you're really you're trusting somebody else to do the work for you, to manage the property for you, to go find the asset, to, to do all of that, right? To deal with the client, to deal with the tenants and all the stuff that goes with, basically landlording essentially. And so, but it's great to go into an investment. It's like, oh, I don't have to deal with any of that. Like they just take care of everything. I just get the distributions. They send me the reports and we get a quarterly update and it's been great. And so because I do it myself, when I tell my investors, I mean, this is how it works and these are the benefits. I mean, it's great because, just like you experienced it yourself. There's a goal that, people have and that I have, that I want to have, so much passive income by a certain, time frame. And then, let's say in the next 5 to 10 years, I want to be at a certain place. And so when I work those numbers backwards, that means that I have to be in so many deals. I have to have, X percentage of returns. I need my money to work for me in this way. And being able to do that and being hands off is it's a huge benefit for me. And so even when I go into deals and I bring deals to my investors, it's good to have that firsthand experience, of just how it works and what it's like. And that way that, if you're looking to go into passive investing, you don't have to, go to work. I mean, at some point you'll be able to slow down. Right. And so, I think the goal, for me too, is to be able to slow down at some point, and not, kind of run the rat race, as they say, every day.
Yeah, I think, for example, passive investing versus active investing, and also like, for example, like especially in the Bay Area, a lot of people want to invest, and everyone wants to invest everywhere. But when you start looking at active investing, where you're actually buying, for example, single-family houses, multi-units, you're actively investing, you're actively engaged in a property, you're actually looking at everything, doing everything, hopefully not fixing everything, but you're working with, hopefully a great team of vendors, lenders, contractors, and handyman and agents to do the deal, but you're actively involved. When you have a single family home, if it's vacant, you're 100% vacant, and that's a big risk. And if you have a 2 unit, for example, you're 50-50, right? And it goes on and on. And let's say, for example, you got the 100 units and 10 units left, you're only 10% vacant. That's okay, because if you factor in the numbers and it makes sense, you can cover that vacancy. But when you're 100% vacant on a single family, it's completely different. You're paying the whole bill yourself, and it becomes way more riskier. So in real estate syndication investing, that's why so many syndicators are out there, educating, providing value, showing what a syndication can do, a multi-unit investing. And the fact that when it gets to 100 units, 200 units, it's way easier to manage than it is to manage a smaller building.
Absolutely. And I learned the hard way in that, Matthew. So I've owned several rental properties, and we've owned properties throughout the years. And every time, I think, and when I started, I said, okay, I'm going to have, 50 rental properties. Well, okay. And that's all great. But, it was just easier to just, why not just buy a 50-unit apartment building? Because first of all, the cost is less. I use one management company versus 15 property managers. It was just, it all just made more sense. The scalability of it made more sense. And you're right, because, I have properties on the Midwest, and it's like, as soon as anything happens, you're out. Your returns on that property is gone in like a nanosecond, because you had to replace the dishwasher or something, or the roof. So, and again, and that's to say that rental properties, again, they're rental properties for a long-term hold. Again, I'm an advocate for, if you're in a market, and I would say that I guess it depends what market you're in, because if you're in a market where there's high appreciation, like where we are, like look at California. We have high appreciation rates. So if you're going to buy a rental property, even though it may not cash flow, as well, but it's going to most likely appreciate in the next, 5 years, you can, multiply your money, 3 times or whatnot, versus buying in the Midwest, where you do a buy and hold, and you're really buying more for cash flow. You're not really buying for, appreciation. And so I guess it just kind of depends, like what your comfort level is, what your goal is. For me, it was buy and hold, not necessarily buy and flip or buy and sell in a short, period of time. But having the one rental property, when you have just an expense of, whatever it is, you have to fix something, you have to replace the roof, you have to, and again, and also these are things that an investor would be looking at upfront anyway. So you should be looking at all of these capital expenses, what the property needs anyway, and you have to incorporate those into your numbers. And so if you, whatever price you're buying it at, you have to figure in what capital expenses that you're going to have to, incorporate in, and that's incorporated into your offer, in terms of how you price it and what you're offering as well.
Yeah, exactly. So when you look at it too, I think one thing you can see, as from example, from being a passive investor to active investor, you can see this too. By us becoming passive investors, we actually can learn really quickly, because we can see what's going on in those passive investment properties, the locations they're in, the numbers they're writing, and their underwriting, and then go through each property that you actually passively invest in. And when you start actively investing in, then you can say, hey, based on this, I have a lot more knowledge, dense knowledge, and how operators are working, the numbers they're looking at, the properties, the locations, how their payout distributions are compared to our investment out in this location, and you can give more guidance to your clientele. That's for me. That's why I'm passively investing in multiple syndications as well, and that helps me build the active syndication. And you could see, for example, some people are really writing really conservatively. They're giving you a longer timeline. So what happens by giving a longer timeline is that, hey, we can make sure our numbers are working for our clients. We're putting the timeline a little bit longer. We know COVID's going on, but with this longer timeline, your numbers are going to come back up, because we have more distributions, more, the incomes, more chances of the rental vacancy becoming less. So the numbers get better over time. If you're looking for 1 year, it's hard for any syndicator to say, I'll buy a syndication and do it in 1 year. It's always going to be 3, 5, 7, 10 years. And the longer it is, sometimes it gets better. Hopefully with the rates being super low, that they can refinance it sooner than later and get to a hopefully an infinite return. I would love to see infinite returns. I'm sure everyone would. And what that means is being able to take all your money back out, having the property keep going by itself and giving you money forever if everyone agrees to that. If not, just buy those guys out,
That's the ideal situation.
Yeah, it can be a really fun one, and just putting that that principle in and getting the knowledge. So let's go in and talk about this. How did you become a active investor, and what's the process to become a syndicator?
Well, I've been actively investing for a number of years, for a while. But as far as getting into the syndication, so a few years ago, that's why I discovered the whole syndication thing and how it was compliant with SEC, because honestly, I really didn't know it was a legal thing. And when I learned that it was legal, as long as you do it properly, and that, I didn't necessarily need to be licensed, as long as I, followed certain rules and guidelines, and I was in, I followed all of the SEC rules, then that's what really made sense for me. So when I was in the middle of kind of reevaluating my investment strategy, going from, these single family homes to multifamily, then that's really how I got into it. And then also because I had colleagues that also wanted to invest, it was kind of just it was just a natural progression for me to go into. And so, transitioning from, single family income properties to multifamily and going in as a limited partner or as a passive investor actually was a great way to start, to actually go in as a passive investor to just kind of really just get my feet wet, just understand the process of getting in. Even though I was very familiar with real estate, I was not familiar with the process of syndication. And so, so going through the process myself as a passive investor was a huge value for me. And then from there, just really starting to syndicate myself and building up, I already had a database. I have a lot of clients over the years. I have a lot of business colleagues. I know a lot of people, being in our business here, we just are well networked. We know a lot of people in real estate. And so, just taking that and then building on that and starting to educate, my clients and just people that I network with on what I'm doing, and start to, just look at deals. And so part of that process for me was just an enormous amount of education and really learning as much as I could and going into it passively myself, and talking to other investors and being really networked with other investors, learning from them, learning how they were doing it, learning, all the mistakes that other people were making, just all the challenges that come with it. And, and then just starting taking my business from there. So that transition for me was fairly natural. The other thing that I also did was I hired a mentor, which was a huge deal for me. So, because it's hard to go through it yourself, because you don't know what you don't know. And so having a mentor who, so my mentor is Vinny Chopra. I'm sure you know him. He owns like 5,000 units or something like that. And so he was really instrumental in helping me and inspire me and motivate me to stay focused and to also just kind of understand the nuts and bolts of things, because, you can learn things conceptually, but, unless you actually go through the mechanics of it, you don't, it's hard to really understand it unless you really go through the mechanics and the steps yourself. But having that mentor to basically tell you, okay, this is how you do this. This is how you do this. Because, I would hit these walls or these blocks where it's like, okay, I would get to a certain point, I would learn so much, and then I'd be like, okay, but I'm stuck. Like, I can't seem to get to the next step, or I can't seem to, we would be underwriting deals all day long, but I couldn't seem to get to, getting an offer accepted. Or I couldn't get to a point where I would, make a letter of intent or an LOI. And so I would get to kind of these milestones where I would get stuck. And that's where a mentor really, really helped me, was to get unstuck and keep moving forward. And so that was kind of the process that I went through.
Yeah, I think that process helps a lot in having mentors, especially when you're going to multifamily and you're doing investing in syndication. Multifamily and just investing in general is one thing, but doing it as a syndicator or even passively is a different thing because you're learning about, operating agreements, LLCs, PPMs, private placement memorandums, and you're learning differences. And they're really detailed, they're really deep, and this is long haul. You're in it with a group of people, hopefully good operators and good people, and it's a lot more money. So then you're definitely way more cautious. And as a sponsor, you're even more cautious. Even if you know the industry, even if you know multi-unit investing, it's still different. It's, using OPM, other people's money, and investing bigger and smarter, hopefully, and that you're leveraging more power to do that to get to a bigger place. It does become easier after the first one. I think everyone talks about a syndicator. The first one's always the hardest. Everything after that is sequentially easier. It's just a challenge to get over these roadblocks, and that's where a mentor comes in because they can kind of guide you through that, handhold you, make sure you're doing everything right, and you're choosing to do everything right because you're working with mentors to do that, and you're watching your clients, investments, right? So having the extra hand holding to do the first one especially is really beneficial. And then after that, they help you build upon it, especially like Vinay Chopra and other guys. They're doing really well. They show everyone how to do it. A lot of other syndicators are also using them as coaches, mentors to do those syndications. But I'm sure after you get your first one in the door, you feel so much better. You kind of know the process.
Absolutely. It's always that first deal, as they say, as Michael Blanc says, right?
Yeah.
And there was so much learning, and there was so much just legal, like just from the legal aspect of it with SEC and making sure that you're compliant if you're doing a 506B or C, if you're working with accredited versus non-accredited investors, and just really making sure that you learned all of the ins and outs and how to protect yourself and your business, so that you didn't do something illegally or were just because you didn't understand it, because something like there's things that can happen that can affect you for the rest of your life. I mean, from a legal standpoint. So it is serious. It's very taking the compliance part of it is very serious. You have to put your investors first. Working and having a lending mortgage business for so many years, I've learned my lesson well about you have to put your clients first, whether they're your investor, your real estate client, your whatever client it is that you're working with, whatever business you're in. But you have to put your clients' interests first before your own and before the management teams, because those are your clients. I mean, that's the fuel that's making it happen. And not managing that well or not communicating that well is gonna put that whole deal at risk. And so, but you're right. But getting through that first one, understanding the legal aspects of it, of how to syndicate. The other thing I can't stress enough is really just having the proper team. So, building, I built a relationship with actually a couple of really great SEC attorneys, and, having a really good SEC attorney, having a good CPA is huge. Having, like if you have a business partner, I brought in a business partner, Krista Means. She's from the Dallas-Fort Worth area. Krista, if you're watching this, hello. And, just having, just having other people, other team members working with you that bring different strengths to what you're doing was really big. I couldn't do it myself. So I really there's a whole bunch of people involved. Because really it's such a huge team effort. And then you have the property management side of it. And then you're bringing in, asset management, property management, all of the other things on the operations side to make sure that your business plan, that you're going to be able to execute on your business plan. And then also kind of the checks and balances, the double checking of your numbers, like having other people underwrite, looking at your deals, getting second, third pair of eyes on it, seeing things that, maybe I missed or that the other person missed, kind of playing through all the what if scenarios. So that was a key thing of it too, is just making sure that you had, good people on your team that were experienced and, knew what they were doing, knew what they were looking at. And, that was watching out for you as well. When you're trying to, get into a deal. So, so as far as, the teamwork and all of that, it was just a tremendous effort. I got into contract on a deal earlier that were like pre-COVID. we had made an offer. We had been negotiating a deal on a 79-unit apartment building in Oklahoma City. And that was a 4-month process, and we ended up canceling because of COVID. But these deals take a long time. And really, honestly, my partner, we had looked at least 100 deals. Like we had underwritten probably at least 100. I mean, at least 100 deals. We'd underwritten. We analyzed the numbers before we found that particular one that made sense. And so really, it's not just like, it's a lot of digging and digging and digging to find a good deal. But when you do find a good deal and you vet it out properly, and it's still a good deal, if the numbers work and you have vetted it and you've done your due diligence, it's super exciting, because then it's like, wow, we actually have a deal that we're really excited about, that we believe in, and that, bringing that to our investors when that finally does happen is really exciting.
So Sara, you mentioned that having a proper team and a mentor is really important. So what kind of advice do you have for new time investors? Because always, finding the first property and investing in that first property is very important, right? It's the first step. So what kind of advice do you have for people who want to invest?
Well, I think probably one of the things that come to mind is I would say getting yourself educated as much as you can, listening to, shows like this or podcasts or reading, material or books, is to, understand, first of all, educate yourself and get familiar with how things work, get familiar with the process, like get familiar with just the general concepts. There's a lot of terminology out there in our business that, people may not be familiar with. So, just educating yourself as much as possible. Like I have stuff on my website you can read about. There's all kinds of stuff out online. The second thing is to, again, just get kind of somebody in your corner that you can just kind of bounce ideas off of, and just, get input from, the people that are around you. But I would say that the biggest thing probably is to not allow your limiting beliefs to stop you. So kind of working through your limiting beliefs about yourself or what you're capable of, or, whether, you should do something or not do something. I mean, it's important to manage all of those risks and assess a deal to see if it's a good risk or not. But what I find is that, and even for myself, when I started a long time ago, even for myself was, being able to get out of my own way, and, get through my own mental stumbling blocks of why I should do something, because it just may not work out. And that's true. And that's part of investing. Investing is a risk. But you have to, but as long as you mitigate your risk and you assess it, and, it's, and you do all the due diligence around it, I think, as a newer investor, getting over that fear just fear about different things, and kind of the hesitancy or fear of just not taking action on your first deal, not taking action on your, investing passively or even actively, but just making that first step, I think was probably the biggest hurdle. And I would say that's probably the biggest thing that I would probably tell a newer investor is to work through that kind of mental block, and, and so that you can get to a point where you can make that decision and take action. That's probably the biggest thing that I see out there, with a lot of people, is just not, being afraid.
Yeah, thank you for sharing that, Sara. One of our viewers actually asked a question. Where do you find the syndicates?
Syndicates. So syndicators, like people ourselves, or the people that are
how do you find out for people like you?
Yeah.
Well, by watching shows like this.
There's a lot of syndicators out there.
There is.
Hard to find, right?
There is. There's a lot of syndicators out there, but I would say, again, you kind of have to sift through, the ones that are good. And it was like with anything, right? You have to find the ones that have a good reputation, that have a solid track record, that you can trust, that you can build a relationship with. This is very much a relationship type of business. It's not like, people want to invest in a good deal, but, more importantly, they're investing in the syndicate that they're doing the deal with. right? So it's not just about putting the money in the property. You're investing your money into the person or the team, that's handling it. And so so I think that's a good question, because there is a lot of content out there. There's a lot of stuff out there. And I think what's important is being able to build a relationship with that person. Maybe not necessarily, directly with, in person on the, in person, but, being able to understand how that syndicate works, their mindset, how they operate, what their experience has been, what value they bring, to the team that they're working on. I mean, all of those things come into play, and, looking at, what they've done in the past, making sure that whatever they've done, whatever their experiences in the past, that they have integrity and that they're transparent, and, in all of those things. So the reputation is really the biggest thing, in my opinion. And so, I think interviewing them, building that relationship, all of those things are really important. But, finding a syndicator that is a good fit for you or for somebody, you do want to interview a few, and you want to see, you want to check out a few before you commit to any one investment.
Yeah, I think for myself, when I was looking at syndications and looking at people to go for, the things I look at too is the quickest way is I was listening to Michael Blanc, a lot of his podcasts. I was listening to Bigger Pockets. I was listening to Vinny Chopra. I was listening to other podcasts as well on real estate syndication. Once you can hear about syndicators, what they're doing, their mindset, their goals, and how they're talking and how they're educating, the ones you can feel who are really providing a lot of value to you, educating you, showing you everything they've gone through, all the success and all the failures, everything they learned, it builds more trust, because you can say, hey, based on everything you've seen, this guy has done a lot. He went through a lot of failures. He grew a lot, but you can tell in the past track record, they have a really good history of really doing really well at this point. And the other part of it is too, syndicators have different amounts. One question one of our guests asked was like, what's the minimum amount? I've seen amounts in the 5,000, 10,000, 20,000, 50, 100,000, 200,000. It really depends on the syndicator, what the property they're doing, and if they let you in. Like, for example, Grant Cardone, he's done a lot of deals, and some of them are 100,000 minimums, but he has recently let some go at 5,000. And the goal for his 5,000 was, I just want to educate, provide a lot of value, let people get a taste of what it feels like to be in this syndication. Even though it's way more work for him, he's giving opportunity to those who want to be a part of real estate investing, and hopefully they can learn and grow from that. I put my money into some of those 5,000s. I put my money into other bigger ones as well. And you can see how operators work after the fact. Are they actually giving you quarterly updates, quarterly distributions? Are they showing you what's going on with the property, or they just disappear? Hopefully not disappear, but you learn a lot really quickly, and you kind of use your gut feeling to get the trust to find the right people you can work with. And hopefully they're on podcasts just like this one, just like Sarah, Sarah's providing a lot of value to us, our community, so you can get a sense of how she works, how she thinks, what she's doing for her clients, and how much she cares. That matters.
Thank you, Matthew, for that.
Welcome. So a part of that too, so let's talk about Legacy Bloom. So what is Legacy Bloom Investments really? And what are you guys doing?
Well, so Legacy Bloom, so my partner and I, so I founded Legacy Bloom a couple of years ago, and my business partner, Krista, is out of Dallas. And so we've been working in this company, it's a syndication company. And so we raise capital, we bring investors into our multifamily deals. But what's really exciting is that earlier this year, we got into the senior living space, and it was actually not, I wouldn't say by accident I got into it. It was actually a business colleague of mine, Paul Rogers, that actually brought me last year, and we had talked about his deal that he was working on in senior living out of St. Louis. And so we started this kind of journey into the senior living space, where we are now actually working on, we're actively working on getting funding for our project. It's called the Cottages of St. Louis County, and it's an assisted living and memory care. It's an 80-bed assisted living memory care community, new construction, so ground up new construction. And because I've done new construction, so I did new construction loans, I've been in the new construction space. So to me, it was just very natural for me to gravitate towards that. And so it's been really exciting. And the more I learned about senior living, the more I was like, this is the place to be. Just with all of the stuff that's been going on with senior living, and even with even with the COVID going on, there's been so much bad press, with COVID and the numbers of deaths in in the senior living space. And one thing that that I learned and that I want to differentiate was all of that stuff that's out there in the news. I mean, the majority of that is actually in the nursing homes, not necessarily like your independent living, assisted living, type of communities. I mean, there is, and again, we need to acknowledge that is happening, but we also kind of have to educate and differentiate kind of, the differences, between senior living, because I think sometimes people just kind of clump it into one. So that's actually a space that we've been actively working in. We are actively getting that funded. We want to break ground later this year. And so we're just super excited about it. We're actually now, because we are in that one, and we're working with a couple partners. We have two partners. We have our business partners out here where I'm at in Roseville, and then we have our partners, our development partners, and our operators out of Tucson, Arizona. And these guys have been doing it for 16 years. They have several developments under them. They've already taken 2 through full cycle. And what's really cool about the new construction is that, you have your construction, you're going in with your construction costs, right? But your equity, but you already have your built-in equity, because, once you've stabilized the property, you're going to sell it off at, like in this case, probably another $8 million higher than what our build cost was. So you're already going in at entry, in the door with the equity already there, because of the new construction, how the new construction works. And so that's been really exciting for us, and it's a space that we just get more excited about every day, and we feel that it's really just in the next like 5 to 10 years, there's so much opportunity out there for it. So, and then also we, educating our investors, putting out as much content, working through our marketing strategy as far as like, the content we're gonna be putting out there, especially on senior living, and syndication and how it all works and all of that. And so, so from that standpoint, the education standpoint is what we're going to be really focusing on as well.
Yeah, I agree. And I think a couple of things we're going to talk about here too. Senior living, senior housing, even Vinny Chopra is going toward that route right now. And one thing he mentioned was the fact that was how many millions of people are going to keep entering senior housing.
We have, so in the next 10 years, in the next like 5 to 10 years, there's gonna be about almost 18 million people that are going to be aging or turning over 65. I mean, that's like mind blowing. And then in the next, like, I think by like 2060, there's gonna be like, almost 90 million people. So a couple things. One is that people are not getting any younger, right? So people will continue to age. We're all going to continue to age. And so that baby boomer generation is not stopping. I mean, that's just going full steam ahead. And so as an industry, investors in that space, we need to be prepared to be able to provide housing for those seniors, whether it be independent living, assisted living, memory care. And the other thing about assisted living and memory care is that it's a little, it kind of from the multifamily aspect of it, right? So, you have that you're providing a need for housing, right? And that's first and foremost. And so you have that, the kind of the real estate aspect of it. But the other aspect of senior housing is the needs-based services component of it, right? So you have the real estate part of it, and then you have the needs-based part of it. And the needs-based part of it is the skilled nursing component of it, where this is not an optional service for people when they go in here. They don't go in and they just decide one day they're going to go live in an assisted living facility because they want to. They go there because they really have to, because they need help and support, because they can't do the daily tasks that they needed to do, or they're suffering from dementia, or they're getting to that point where they're not able to take care of themselves, and their family's not able to take care of themselves, or take care of them. And so this is not just something that, they just decide to do and just go into and pay, $4,000 a month to do, or actually more than that. And so from that standpoint, it's really important to remember that, the needs-based part of it is really what makes it unique and different. compared to, when we look at, how multifamily works. You have that second component of it. And the other thing that's really astonishing is that the number of dementia, as far as the number of kind of the rate of Alzheimer's, is there. The Alzheimer's Association is projecting that's going to triple. The numbers are going to triple by 2060. And then another really interesting statistic was that by the time somebody reaches 85 years old, their chances of getting some type of a dementia-related disease goes up to like 35%. And so, the average age of people going into assisted living facilities is about 85. And, so kind of with the rate, the increase of dementia, the increase of kind of the, people, their, how long they're living, people are going to continue living longer and longer. And so really, I think the meat and potatoes in this space is going to be in the next 10, probably the next like 10 to 15 years.
Yeah, I couldn't agree more. I think that you're right. If you're especially doing syndication right now, syndicating to senior housing is actually a really great place to be. Like you mentioned, the numbers make sense. You're building, for example, new development, new homes, new senior homes, and the property is already built in equity, because once you finish a new development and you get it established, stabilized, that these people can live there, they get to enjoy it. You're creating services too for the owner, or a user can create services for these people. They get to enjoy a beautiful new place to be. You're stabilized, and your vacancy rate is super low because they need a place, and the fact that there's so much growing numbers of people who need this service, that you're kind of guaranteeing yourself, as long as you're in a good city that makes sense with population wise, and they're all here from post COVID, they're all here still, that you can have a good place to use, and those numbers make sense. Plus, you have hopefully the government helping with assisted payments. Or Medicare.
There is, and there is some of that. The majority of the assisted living is private pay. And the reason for that is because we have more control. Operators have more control over, the operation side of it. You just have more control. But there is a small percentage that do get government subsidy, and that we have to, cater to that need as well. But you're right. I mean, I think, again, the senior living space is something we're very excited about. The multifamily space, we're very excited about. It's always, you're addressing the fundamental human need of housing and care. And so I don't think, in the right market and for the right deal, I think that, again, long-term, you can't go wrong in that.
A question one of our guests asked too is, how do you actually pick a partner?
Good question.
I think that's really hard. So how'd you pick your partner?
Have lots of drinks with them. I'm just kidding. It's just like any relationship, you need to spend a lot of time with them. You need to ask a lot of good questions. You need to understand just kind of who they are as a person, how they operate, how they think, how you guys get along, because again, it's like a marriage. You need to get along. And you also need to see what you both bring to the table, right? In terms of your skill set. And so, if you bring complementary skill sets, then that's really an ideal situation. Like for example, with my partner and I tend to be very, my strengths are in deal analyzation. I'm very process driven, very on the business side of things. Whereas my partner is very good and well connected to finding deals and talking with brokers and kind of being on the boots on the ground, like looking at deals and kind of working in those relationships. And then she'll bring the deals to me and I'll look at the numbers and so kind of having complementary skills is really important. And then just being able to get along and having, where your personalities mesh is also really important. So again, just building that relationship with that person, being comfortable with them, being, say, hey, this is a person I'd like to work with. This is like, we have a lot, our goals are in alignment. We have the same goals. This is what we want to accomplish. And then making a commitment and saying, hey, let's just do it. And you just start working together, and see where it goes from there. Like do a deal together. Just work together in some capacity. So you get familiar with how they work.
Sound familiar, Susie?
Yeah, yeah.
Susie and I are actually partners too in a lot of different things, especially sales and the podcast and other events. And I think one thing is looking at, like you just mentioned, profiles. Like I'm exactly like you, Sarah. I think because we're born on the same day. Happy birthday from yesterday.
Happy
Both of us
birthday.
are same
Yeah.
birthday. So we didn't know that.
We
It's
did.
funny. How many people do you actually meet on your same that has the same birthday as you? I don't know.
You
many.
know, very few, and now that I think about it, I think you're actually the only one that I have on this I've met that has the same birthday as me.
That's so funny because exactly the same. You are the
And
first.
we only
person
found out
I
through
met.
Facebook.
Yeah, we met through Michael Blog, Facebook, and online, and we're same birthday, and we're both in real estate. We're both investors. We're both syndicators. You know, so
Yeah, it's pretty funny. Yeah.
and there's many more things that match, and that is funny. I'm so glad to be have you as a person on the same birthday to share with me.
Thank you. You
Yeah.
as well.
And speaking of partnerships and things like, a disc profile, taking profiles, assessments to understand who you are, how you work, how the other person works. Is it complementary to each other? Do you guys have mutual beneficial things that can help each other, your strengths, your weaknesses to help each other grow? And like you said, it's like a marriage. So start dating first. It's your work wife, work husband. You start dating, getting to know each other. Do one deal first, see if that deal works. Do another deal, keep going until you feel really comfortable to say, yeah, I'm ready to be committed to you and let's do this and make it fun. It takes time, takes patience. You want to see the goals of everyone because people have different motivations. People have different goals. People have different times in their life, what they can and cannot do. And as long as you guys respect it, understand it, go around it to make it work, then it can be really good and mutually beneficial. Susie and I have been doing really well as partners. We're doing really good working with each other, helping each other through our hurdles, and also helping each other push each other to be better. And that's a good strength to have because it makes you do what you couldn't have done by yourself. It makes you build more and have way more leverage to focus on what you focus on best. I'm really analytical. I'm data driven. I'm all numbers and I'll fight to get you the best deal, right? Whereas you have others who are boots on the ground, relational, networking, ability to go meet, call, talk to people and get everything dialed in with you to verify with you to make a deal done. That's the best part. You can't do everything yourself. It's too hard to do everything yourself. And especially in syndication world, you need a team. The team has to be everyone. And you can't be a syndicator by yourself to do a whole syndication, hundreds of millions of dollars. It's almost impossible, right?
It is. It's impossible. And all the good syndicators out there, they all have stellar teams around them. And that's really what makes them successful.
Didn't Vinny Chopra have like a huge team? Like a super
he's got
team?
a huge team.
Yeah. And that's why he's doing so well. He started with $7 and built a huge team.
He did. He started with $7 in his pocket. He came from India, and he built on that. He was an engineer, had a technology company, built all and then he got into syndication. I think he's been in like 14 or 15 years now, and he's done. I think he's on his 28th or 29th or maybe 30th syndication now.
Yeah, I think 28, 29 around there. I think almost 30 years now. Or is it? It's been for a long time.
It's been a while, but I say, there's always, regardless of where you are starting, if you're, just having, being motivated enough and having the willingness to learn, and to really stick with it, because it doesn't happen overnight. I mean, just, it's a slow process, just like you and I were talking about earlier. It's a slow process. It does take some time and it takes a lot of work and effort. But if you're willing to stick with it, I absolutely believe that it can be successful. Just like, and again, we're in real estate. So real estate is not an overnight kind of thing. And so, I think about it that way, like being a syndicator, it's like you're following the life of real estate, and real estate is, several years, many, many years. That's, if you're willing to stick it out, 5 to 10 years, then that's kind of how long, you might stick it out for. Or longer.
That's actually a good point. Let's add this. In real estate, like you just mentioned, it's a long game, and you want to be an investor, you want to be a syndicator, you have to play the long game and go in looking to educate yourself as highly quickly as fast as possible, understand everything, do more due diligence than anyone will do out there, because it makes you so much stronger and better. When I built my syndication, I spent over 4 months to a year just doing the legal part of it. And the reason I took that long was because I was just educating myself on everything. I was reading every lawyer syndication website. I actually gave feedback to them too. I read every page. I gave them grammar feedback. And I said, hey, how come this doesn't match this? Why, you said this with different dates, of course. And they said, wow, you're the number one person to give me this much feedback. You actually improved their PPM because you did the due diligence. Overly analyzed it, but the reason I overanalyze it just because I want to know, I want to be in ins and outs and be really confident for our clients and investors that we're doing the right thing for them. So over education helps, but at the same time, analysis paralysis. You still need you still need to educate, and you still need to push forward. So the challenge is this: push forward, learn every day. If you can't write an offer, the goal that Bigger Pockets said was that just start analyzing every deal, analyze 100 deals until you feel confident, and then be like Michael Blanc and pull the first trigger with a group of people that you trust so that you can get through the door. Whether you're 1% ownership or 100% ownership, you still need to pull the trigger to do it. And once you get your first deal done, then the second one will come in a week later or a month later. It'll come really quickly. I think he even mentioned it took like 12 months to 18 months for his first deal. And most syndicators take 12 months to 18 months for their first deal. That's the average. If you can do it sooner, great. Make sure you're cautious and understanding, but do it.
Absolutely. Yeah. And I remember, Matthew, I think what was it, like a year and a half or whenever it was last year, I remember you were talking about that, how you were so diligent in doing your research and on the legal research. And I remember thinking, I'm like, that's really great. I mean, like, I don't think a lot of people actually do that. And so it's funny you mentioned that because I had that thought. Remember when we were interacting, through the kind of through some of our forums.
Exactly. And yeah, it's fun. It makes you're aware, you're confident, you know what you're talking about, and you're just here to provide value. And then when you go into the numbers, your investors trust you more. And my real estate career and our career has been built on trust and relationships and investments. And in San Francisco Bay Area, we do a lot of multi-unit investing, and we have built a lot of equity and money for them. Now it's our turn to build it together.
Right.
But they have that trust built in because they know your numbers, you know what you're doing, and you're here to always build for them. So right now it's about 10 o'clock right now. Let's end this off. And how do people actually learn more about Legacy Bloom, and how do people actually reach out to you?
So you can visit my website. It's www.legacybloom.com and check it out. We have some webinars and whatnot posted that you can watch. And then also, I'm going to also be posting my podcast that I'd love to have you as a guest on. Mm-hmm. And my podcast will be launched here probably the next month or so. And that is called 50 Shades of Wealth, Confessions of a Real Estate Investor. Nice. So Matthew, you'll need to give us your confession on my podcast interview. So just be prepared.
Of course, we're down to be there, down to be on your podcast. Love to be part of it. Love to do what we can to help and just watch it grow, because I think you're providing a lot of value, and we want to see more from you, especially this podcast and other things we've been talking about. It's great that you're actually going to be sharing this on your podcast and more. And these educational events that you're doing actually help the community. As syndicators, we all want to educate everyone out there that what syndication is about. And I'm glad and appreciate that you're doing that.
Thank you, Matthew, for having me.
You're welcome. We'll talk to you soon.
Thank you so much. Bye, everybody.
Bye.
Bye.